Purchasing a rental property and renting it out to tenants can not only give you a steady income, but it can support you with more than enough money to pay the property's mortgage. But if you're in the real estate game, what is the one thing you should know about buying properties? Well, the answer is simple. You make money when you buy. In this video, we're going to cover something you absolutely need to take to heart before buying your first rental property. But before we dive in, there's a lot to think about, like a lot. You need to evaluate the expected income, expenses, returns, rewards, and risks that come with the property. That way you can make the most of your investment. Not only will I give you the most important lesson to learn about rental properties, but I have also added other things you should know on top of this very important hack. So if you're now ready, the one thing you must know when buying your first rental property is, number 1, what matters most is purchase price. Perhaps if there's only one thing you need to know about real estate, it's this one. As the saying goes, you make money when you buy. That means you need to purchase your investment property at the right price to ensure profitability after expenses. There are some markets where high rental rates justify a higher purchase price, but for the most part, you want to aim for a lower price to increase your chances of positive cash flow. Before you buy, make sure to run the numbers. Calculate the market rents and make sure they can still produce a net positive after accounting for vacancies, debt costs, and rental expenses. And don't forget about holding costs. If you're not able to find tenants right away, you'll still need to pay for things like property taxes, insurance, and maintenance. Is that it? Well, if there's only one thing to learn, that could be it. But why limit the things we can know to one if we can have more? Watch the video until the end to learn the other things you need to know about buying your first rental property. But while we're at it, please like and subscribe to the channel for more content like this. Share this with others so that it can spread to more people. Number 2, income potential. Of course, you also need to consider the income potential. Let's face it, if your property isn't bringing in enough cash, it's not worth the investment. That's why the 1% rule is your new best friend. This rule states that the monthly income you receive from your tenants should be equal to or greater than 1% of the property's total value. So if you're eyeing a $200,000 property, you should be making at least $2,000 per month in rental income. But sad to say, there are always exceptions to the rule. So maybe you have a killer financing option or a hefty down payment that allows you to be a bit more flexible. That could be great too. But the point is that you want to make sure that your monthly income covers your mortgage payment and then some. Why? Because life happens. Tenants move out, pipes burst, and roofs leak. You want to make sure you have a financial cushion to fall back on during those inevitable lapses between tenants. Number 3, location is always everything. As I've emphasized time and time again, location is everything. And I'm not just talking about the geographic area. You need to consider everything from the quality of schools nearby to the proximity of the nearest karaoke bar. Think about it. If you're looking for a place to live, you want to be close to the things that matter to you, and your tenants are no different. They want to be near the action, whether that's a bustling downtown or a serene park. But with all of this, you need to remember, a prime location comes with a prime price tag. That's why you might want to consider a fixer-upper in a less than stellar neighborhood. With a little elbow grease and some renovations, you can turn that eyesore into a rental goldmine. Nonetheless, a low-quality house in a prime location can still fetch a high price. But for the most part, you want to find a balance between location and cost. Number 4, the tenants. Are you looking for a family to settle down in your property for years to come? Or are you targeting the college crowd who just need a place to crash between classes? If you're looking for student tenants, you'll want to focus on smaller homes or apartments that are already furnished. Students are only staying for a short time, so they won't be too picky about the overall quality of the property. But if you're targeting families, you'll want to invest in a higher quality home and plenty of amenities. Families are looking for a place to call home for years, so they want something that's comfortable and functional. Now hear me, your ideal tenant will also depend on your budget. If you can afford a fancy home in a nice neighborhood, families are the way to go. But if you're on a tighter budget, you might want to stick with smaller properties that are easier to maintain. No matter who your ideal tenant is, remember to keep personalization to a minimum. You don't want to spend a ton of money on renovations and then have to redo everything when your tenants move out. Number 5, plan for contingencies. Here are some questions you need to consider. What if you can't find tenants for a few months? What if you need to make expensive repairs? What if you have to evict your tenants? These are all possibilities and they can all be expensive. That's why it's important to keep at least 2 months worth of rental expenses available. That way you have a vacant property for a short period of time. It won't be a financial disaster. But don't be sad, there are ways to minimize the risk of contingencies. Make sure you're investing in a property that's in good condition and won't require a ton of expensive repairs. And also, screen your tenants carefully to avoid any potential eviction situations. And if you're renting to students in a college town, be prepared for the summer months when there are fewer students on campus. You might need to get creative with your marketing or offer incentives to attract tenants during this time. The bottom line is that contingencies are a fact of life when it comes to rental properties. Number 6, keep an eye out for homes with outdoor space. Outdoor space is a hot commodity. Renters love having a large deck, patio, or backyard to call their own. And if the outdoor space comes with a view, even better. But hey, take my advice too. It's not just warm climates where outdoor space is valuable. Even in colder regions, a large deck with a stone fire pit can be the perfect way to keep warm while entertaining guests during the colder months. Not only that, outdoor space gives your tenants the opportunity to personalize their living space without having to make significant changes to the property. They can add plants, outdoor furniture, and even a grill to make the space their own. When you're searching for rental properties, keep an eye out for homes with outdoor space. It's an attribute that renters will often prioritize, especially if the surrounding neighborhood is cramped. And if you're feeling extra generous, consider adding some outdoor amenities yourself. A few potted plants or a string of lights can go a long way in making your rental property feel like home. Number 7, vacation rental. One thing I learned about being in real estate is that vacation rentals are a whole different ballgame. If you're lucky enough to own a property in a warm climate or near a tourist attraction, you may have won a jackpot already. Yes, you might only be able to rent your property for part of the year, but you can change much more in rent each month. And tenants will expect this since they understand that short occupancy is a liability for the owner. If you're considering purchasing a property in a vacation region, consider marketing it as a vacation home. This will open the door to a whole new range of tenants you may have not previously considered. But keep in mind that vacation rentals come with their own set of challenges. You'll need to be prepared for high turnover rates and potential damage to your property, and you'll need to be on top of your marketing game to ensure that your property is always booked. Number 8, vacancies will happen. Don't be discouraged if I say that vacancies are inevitable. No matter how great your property is, there will always be turnover between tenants. I know you want to minimize rental turnover as much as possible. That means spending less money on improvements, marketing, and vacancy. Even if this is so, vacancies will happen. So how do you prepare for them? A general rule of thumb is to prepare for a 10% vacancy rate. That means if you have 10 rental properties, you should expect one of them to be vacant at any given time. But in hot rental markets, like we are seeing today, rental vacancies are closer to 4% or 5%. That's great news for landlords, but it doesn't mean you should let your guard down. Make sure you have a plan in place for when vacancies do happen. Have a marketing strategy ready to go and be prepared to make any necessary improvements to your property to attract new tenants. At the end of the day, a rental property can be a stable source of income, but like any investment, you need to know what you're getting into before you buy. Take a look at the potential income, costs, and return on the property in conjunction with what we have discussed today. And yes, don't forget to think about the risks and rewards as well. So what was your experience when you first bought your rental property? Share them in the comments section below. Be sure to give the video a thumbs up and subscribe to the channel for more videos like this. In fact, if you want to learn exactly how to buy your first rental property in 9 easy steps, watch this video next where we'll tell you exactly how to get started. We'll see you in the next one.